Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you gotta get spotted. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
Good morning, everybody. Hold on, I didn't get the music ready. I'm not ready. Go play the thing. Good morning, Octavius. How you doing? Well, guys, yesterday was quite the day. Let's get that started. Come on. There we go. Yesterday, quite the interesting day. You just see it here in the chart. Okay. Treasuries moved up big time, a whole handle up to well above 107. Actually, here in the overnight, tagging 107.16. So a lot of some of this really ugly action that we had earlier in the month are erased. Now, the thing is that I don't really feel like the fundamental situation is a whole lot different. Of course, people getting excited because Powell seemed relatively dovish yesterday, and it's like, okay, the pivot's in, now we can buy stocks, right? But, it kind of all depends on what was all of this selling. I think that a lot of this selling was just, sovereign wealth funds getting out of the market. So, maybe it's okay. But, these sellers could come back because these sellers were selling in spite of, whatever they thought the Federal Reserve policy was going to be, right? So keep that in mind. And of course, we've got like a bunch of big data coming, right? We've got U.S. initial jobless claims here in a minute 30. So go through the rest of these really quick. S&P 500 staging a very substantial rally. Oil not jumping though, so that makes things even better. Gold and silver kind of, doing okay. Not making huge moves off of yesterday. Bitcoin taking another jump. Bitcoin seems to think, well, there's a big jump overnight. I don't know what that's about. Bitcoin seems to be on a bull run now. And of course, it's always disconnected from what everything else is. And the dollar getting hammered. They declined a decent amount during yesterday's session, but now here in the overnight, they're really getting killed. So we are definitely in a different environment today, and maybe that's good. Maybe that means that they buy the treasuries. But here we got in U.S. initial jobless claims, the estimate is 210 versus a previous reading of 210. There are some signs of things slowing down, so if I were to make a play on this one, I'm not super confident about it this time, but if I were to make a play, I think that I would be betting that jobless claims are slightly higher than anticipated, but let's see. Okay, so I'm correct. 217 versus 210, and that gives them a little bit more fuel to move up. The action over here in the Treasury, quite disorganized there, I must say, although it is overall buying. I'm not liking the spread over here in the micros, so I guess I'm gonna sit out. Yeah, Bank of England did have their... Did they do a press conference? I've never seen or watched. Oh, it's just starting now, huh? Let's see here. Do we have stuff later today? Yellen speaks factory orders at 8 o'clock, durable goods, 4-week bill auction. Well, there having been a Federal Reserve meeting yesterday should mean that we get plenty of flows to drive us. I wouldn't have minded 467. But I guess that wasn't an option because I didn't, I don't think that there was any volume went off there. My mustache has gotten long enough that it's starting to touch my lips now, so I'm trying to tame it here a little bit. Liquidity pretty light here. There is a gnat in here. So I think that we could see some big meta orders trading through today from more like hedge funds. So let's try and game that out a little bit, because this is one that's like hyper speculative. So I'm a little more comfortable kind of like talking about it and discussing it, because I don't think I'm giving away like a huge edge. So if it was a hedge fund, how are they going to come in and do it? Well, they are going to go and do some meta orders, but the hedge funds tend to be a little bit more risky. So they'll kind of be really sneaky at first and then execute a ton all at once, and then they're done, right? Or to put it another way, if I were to draw a picture here for you guys, if I can get this thing to work. I wonder if this has anything to do with, I found the other day that the problems I was having with ATAS had to do with my mouse pulling rate. I'm wondering if that is affecting this thing that I have. So normally with a large meta order, you execute the most at the beginning, and then it's like that, right? But if you're doing risky, you do it the opposite, right? You're really sneaky at the beginning, and then you execute the bulk of it at the end of your execution, right? So you might see that. So we want to keep an eye out for kind of like some sneaky trades. It could be either direction too, right? Could be that they continue to buy the treasuries off of Powell's comments, and they say that's really significant. It could be that these guys that were selling it, that for whatever reason that they were selling it, they come back in and say, no, your rates can't go back that much. ATAS had their change. Well, we're going to go back to it, because I still want to program something in it. I'm not going to switch, but I mean, the thing is there is the investment into the platform, right? So I own the Jigsaw license. I'm unlikely to switch into a different platform, unless they gave it to me for free and it was like a super, super awesome platform, you know? But I do want to try programming something in it. So at some point we'll do that. Don't let me forget. Anyways, I do think, though, the market seems to be relatively more tame than usual. Now, this is the first time I can recall the Bank of England doing a conference while we're trading live. But maybe it's happened before and I was just like, nah, we won't put it on. We'll just listen to it on the News Squawk. So that might explain why they're being a little bit more tame than usual. We are giving back a lot of those gains that they had off of the jobless claims. But the cumulative delta is still very much long for the session, so... come over. There's not too much interesting on Zero Hedge yet. So first thing I'm noticing this Bank of England thing is that their decision was 6-3. It was not unanimous. I don't know if that's significant over there or not. Payments firm PayPal Holdings said on Thursday it had received a subpoena from the SEC tied to its US dollar stablecoin PiUSD. PayPal is the first major technology firm to launch stablecoin in August. So that is interesting. If the SEC is going after investigating stablecoins, that could be extremely bad for the cryptocurrency market. And that spike overnight, sometimes when you see big spikes in Bitcoin that seem to come out of nowhere, they're like front-running bad news to try and blunt the impact of the bad news. So that has me a little suspicious now that in the next few days we might get some more headlines about Bitcoin. Well, they had a decent pullback there, but now they're right back to 19, and the 30-year is pushing. The 30-year is pushing. So that kind of sucks, because I was hoping that maybe we were getting an opportunity there, and I don't think that we really got it. Something happened in the 30-year, kind of short-circuited my chance. I suppose I could try going here at 3655, but I don't really like the price risk on that one. So I'm going to come back to my volume profile and I'm going to start looking at, okay, so far they do appear bullish. They are extending. What are like some of the big levels that we've got ahead of us? Well, on 107.22 half. 108. So we're kind of in a little, well, I would say that this big sweep right here has been, you know, of course it doesn't matter because it's so far back, but it also was filled back in. But so that doesn't really give us a very good very good benchmarks. What about over here? Okay. Well, at 108, let's see here. Is it like 03? So the next stop is 108 still. So we're very far away from the moving averages too. Yay, TLT. Yeah, so let's take a look at that. Are you positive on your TLT position now? I want to see. Let me go back here in a second. Where was it? 85 and 87. 85 and 87. Was where like the really big strikes were. Okay. So the 85s were asking for 45 cents. So the options at the 85 strike are not profitable yet. But they are like starting to get in the money, right? You've been buying it periodically throughout the year. Wow. So your cost basis could be anywhere in here. but for the options, okay, that puts us in an interesting spot. And we're down through 465 now. So it does appear to me that the market is reacting to the Bank of England. So if that's what's driving them, I don't think that I necessarily want to trade, because that's always kind of messed me up. Your cost basis is 91. Oh, okay. That's quite far away. Well, I guess it's not that far away. I mean, if there's like a real pivot here, right? Then it might not be very long before it's in the money, but I was more thinking about, okay, there's lots of options that are out, and the options were basically saying 85 and 87 over the next week, essentially. Can we get above those prices? And, you know, I've expressed a lot of skepticism that all these people buying lotto tickets are actually going to get paid, right? And we can see here this Federal Reserve meeting and everything else that's going on has really, really helped the treasuries out. But even with that, they haven't gotten to the point where the options are becoming profitable. So there was a lot at 85 and there was a lot at 87. So if we got above 87.10, then I think it would really start to be like, ooh boy, right? Because then those start to pay off, and then somebody probably has to start hedge more aggressively, right? Then the gamma starts to come into play. Okay, so there has been a little bit of back and forth here. We are getting kind of like a cluster of sorts. Remember yesterday's rant about fat tails? Yes. Where I complained that a lot of strategies don't account for fat tails. I don't think I actually made that argument yesterday, but like I make that argument almost every day, so I probably did make that argument yesterday. Okay, why is the market moving up if the rates got left unchanged? Well, so it's not just about what they did with the interest rate, but what they're going to do with the interest rate and the tone that you get out of Powell. And the tone that we got out of Powell yesterday was, well, they seem unlikely to raise rates in December. He was very careful to not, say, oh, I don't think that we're going to, or I think we're going to. He's gotten very good at not saying anything. But it does seem quite unlikely that he will raise rates in December. And so the market is making the calculation that we have reached the peak of this interest rate cycle, that there's not going to be another rate increase in this interest rate cycle. And so because of that, you're getting people buying the treasuries and buying stocks and so forth. Now, I think that all of that was things that we could have surmised 2 days ago. So for me, this doesn't really shift my expectations of rates very much. But there's this other thing that's been going on, which is that the rates have been very, very aggressive. And it's kind of like, why? Why have they been selling so aggressively? And our best theory for that has been that it was sovereign wealth funds. So they may not be doing anything relating to interest rates, right? So maybe all of that selling was not really tied to fundamentals very well, right? And now you've got people that are feeling optimistic because they think the interest rate cycle is over, they're going to buy. That kind of leaves us in a situation where in the short term, the treasuries can move up, and we've done so quite aggressively. And I mean, I tell you what, if you bought on that, it was an easy trade. I did not buy, and I haven't seen a good opportunity for me to get in, but if you do get in, it's been a good trade. Like I was looking at 6-7, we're already 3 basis points lower. 6-7 was like after the news, there was maybe a possibility of me getting filled there. I'm waiting because I think that they're reacting to the Bank of England right now. They keep talking. Well, yeah, that's a really good point. Is that we are not back to 2% inflation, but the Federal Reserve seems to feel that we're on a pretty solid path towards getting there. So if the Federal Reserve started to express doubts that we were going to get there on our own, then I think that you would see rates start to heat up again. So I'm just noting an interesting thing. If I can shift gears really quickly, Nassim Taleb is tweeting about the Israel-Palestine conflict, and he says, trying to figure out beyond the verbalism, the properties of a conflict that in 75 years has been progressively getting worse, not better. The worst attribute both Palestinians and Israelis think that they have time on their side. And I'm thinking about that, and I'm not sure if that's true anymore. I think that was true a month ago, but Iran was saying that if a ceasefire isn't made soon, that the Zionist regime will regret it, right? Iran seems a little upset. It seems like Iran is looking at like all of its work like just getting trashed all at once. So like I kind of wonder if the Palestinians really think the time is on their side anymore. If you tell him he's wrong, he will insult you. Well, I'm not gonna argue with him on that particular point, because he probably knows more about the conflict than myself, and we're talking about something that is, I'm talking about like a more recent change, so I'm talking about something that's a little speculative. He sure does go after people though, and he argues with them, right? I don't really see any comments on it. I think ZF wants to size it at 12. Oh, I don't see it at 112, but I see it at 12. Probably moved. The treasuries don't seem to be showing any signs of slowing down anytime soon, right? Like, you're just in the micros, you just have to sell the low. That's been the only way. It's not been pulling back or anything. But again, it's the Bank of England is speaking, and I think that they're reacting to that, so. It also seems to me that, like, the offers aren't really standing in the way. Like yesterday, I took a counter trade or two and was kind of able to come out break even with it because there was some absorption, but this one there doesn't seem to be the absorption. You want me to buy another share of TLD? Well, doesn't the S&P 500 doesn't the NYSE need to open first? So that means that we've got a whole 40 minutes before Uzi can save the treasury. Oh, can you do it in the pre-market? I know I'm always nervous about doing stocks in the pre-market, though. You don't get very good execution. No one likes war, but sometimes it seems like it's the only solution. There they go again. Like that's another basis point, just like that. Like it's just going so fast. Well, if you do it as a limit order, I don't know if you'll actually get filled. I don't know. Try it. I'm betting in this situation you wouldn't get filled on your bid, especially in the overnight. How do you define a fat tail? So a fat tail is a statistical outlier that is so far from the center of the distribution that it can completely change the statistical properties of the distribution all on its own. So we tend to think when we're looking at a distribution, you know, and a lot of people think that it means like, oh my gosh, that fat means like how big these are, but it actually means how wide this is. Right. I don't understand where you're getting at. So if you go into Nassim's technical inserto, he kind of goes a little bit into how people that the definition of fat tails has kind of been shifted around and so forth, but that you know his definition, which he thinks should be the proper definition, but obviously isn't followed by everybody in the industry, is, you know, how far out those outliers are. Jeez. This is just really going. I would say this is like extremely one-sided action. Like, you notice how many places where the no bids even went into it? They're just hitting into offers the whole way and not stopping. You know, they can't go much further than this without getting a pullback, but it's not happening. Something really wild is happening today. I'm really unhappy that I'm missing this one. I could have just gone short when we got here, but I'm so picky. Oh, it should add that the yen is moving here, so. Okay, I've never taken it that far. When you, to be more precise, when you build your strategies, which distribution do you use to see if that tells normal, exponential, tons? So I have like an indicator, right, that will show you a distribution of something like the range. And there is a property to display the graph on an exponential scale or a log scale. So maybe you need that, but I don't, I haven't gotten to like trying to, what we say, model the distribution, come to a graph and determine which kind of distribution it actually is, and then make some conclusions based off of that. I haven't taken it that far. Well, you're finally getting a node here that is maybe a little bit more volume. But again, like since 20, they just haven't been stopping. Like there was some volume. There was at 20 where I thought, okay, this might be enough to hold them for a little bit. It hasn't stopped. You know, a little bit of a pushback. Maybe another spike here and then come back to 24. Let's see. I feel like that the market is being a little overly simplistic about this, but maybe I'm making it too complex and nuanced. Can you show the cost basis? Well, yeah, if you look over here in the treasury, like they're not anywhere close to the cost basis today. At least not in the 10-year. Might be different, might be a little closer in the 10-year, but, or sorry, the 5-year. But in this instance, we're being moved by a currency, so this sort of a metric isn't going to help you at all, right? It's just going to keep going. It's a real outlier, though. It's a real outlier. I mean, today, what you're seeing right now is one of those tail events, I would say. This is going a lot more than anything I have that would allow us to expect it. And the amount of volume too, like since the news, like if we just go to the move after the news, okay, it's only 10K, but when we go over like the whole session, it's 30K. We're not in market madness territory. I don't know, man. This is of course there's been like overall days where we move further and so forth, but the one-sidedness of this order flow is one of the most extreme I've ever seen. And it just keeps going. The only consolation is that because it's on the upside, you know, they're a little bit more orderly about it. I should note too, by the way, that the liquidity has recovered. I wish I had been paying a little bit closer attention to that, because maybe when the liquidity had recovered a little bit, I could have been more aggressive at getting in, you know. I'm kind of concerned that the bulk of the move is maybe past, and that if we get in, we start to get into, you know, where it gets a little difficult. So there's a 5K iceberg at 25. So that's definitely a change from what we've had, right? I don't think that I would want to take a short here, but a possible profit-taking zone. Although with the trend that we've been getting, usually the way that one will play out is that there will be another push to a new high, and then they'll come back to that node. I should also say that this move is not the flows that I was anticipating in terms of like maybe some sneaky hedge funds will come in and try and do something. Nah, this seems like a move in currencies based off of the Bank of England speaking. And I'm not even sure if it's anything to do with the Bank of England per se, as much as it is just an excuse. And maybe they got tired and they just went all in. Well, this is what I would consider to be like an unhinged market, which is to say that like people aren't coming in and trying to orderly execute their bigger. This is like, I've just got to get in now or I'm going to miss it. Right? And the market maker has just completely, yeah, I'm not going to hold any offers. FOMO is hitting the bond market, says Forex Live. That's really what this feels like, yeah. The drop in treasury yields isn't just about repricing of the term premium. As the market grows less fearful about a hawkish Fed, pricing for December 2024 rate cuts are now up to 85 from 75 basis points last week. That and strong risk appetite are weighing on the US dollar, which is trading at session lows across the board, yeah. When what I see... Wow, okay, so by the way, that big iceberg was at 25 and they did make another push, but that was so fast and so aggressive and the bidding is so much, I'm not even sure if they're going to come back from that. So, like, this is insane because I was looking at 6.3 and going like, well, I don't know if that's real. And now we're already another 22 basis points off. You know, I really don't think that this... concept of like toxic flow is necessarily super useful to us. If I was writing a market making algorithm, then that would maybe be a different thing. But they're buying a lot, and it's become disorderly. It started out a little odd. The way that this started out was a little odd because their reaction to the payrolls, the jobless claims numbers was a little, okay, it's positive, but not like super much. And then they just start taking off like for no apparent reason. Well, it's not, okay. The place that toxic order flow comes from is basically a market maker takes a fill and then it goes right through them and it doesn't even stop. They call it toxic order flow. So I think that there's this kind of, when you hear that term, that there's kind of this feeling that there's like something about those orders that are wrong and you don't want to take them. But it's really toxic for that market maker, right? Is what it means. And right. Because how are you to say this set of buy orders is toxic and this set of buy orders is not? It's only toxic if you're taking the other side of the trade and they move through you, right? Right? So unless I am a market making algorithm, the concept of it being toxic isn't really very useful to me, I don't think. If ZN makes it to evens, the put writers will get margined and have to roll up. Well, they are doing the whole thing that I kind of predicted, right? I said there was a large order at 25. There might be another little push higher, and then they might get kind of pulled back down to the 25, and it looks like that is happening. We'll see if we get any kind of order flow the other direction. You are getting a decent amount of selling here at 25.5. All this time trading, I've never found a reliable futures option flow. I've never found one that would let you see stuff live. That's for sure. But I think that you have to do the quick strike data, right? But you don't even need the data to know what Octavius is talking about, right? Because you know that it's every quarter of a handle that you see stuff, right? So they had one at 24, right? Now the next one is at 108 even. So he's right. If they get to 108 even, then option writers start to have a little bit more problem. Could this be the beginning of the melt up? Well, I don't know. So we run into a very interesting conundrum here, right? Like, I don't think the market is thinking this through very well, right? If stocks just pop off here and everything goes bonkers long, then that just means that the Federal Reserve will get concerned about inflation and have to smack the market down again. So a relief rally, because really the increase in yields over the last month, 2 months has really been a little crazy and in my opinion, not in line with the fundamentals. This is probably sovereign wealth funds and so forth getting out. So yeah, this could just be like a relief rally. If this is like the pivot and we're ready to go to new all-time highs and all of that sort of a thing, then that presents real problems, right? And then you come back into this whole thing, which is like, is there going to be a recession in 2024? Well, the Federal Reserve doesn't seem to think so. I'm just don't see how that scenario can play out and we not get another bout of inflation, you know? And all of the economic indications that we're getting kind of suggest that the economy is weakening. So you could see something where, the stock market rallies a little bit and it's like a sucker's rally. And then, eventually the economic weakness from the higher rates comes through and smacks them back down. That could happen too. It's not called toxic because it only serves the market maker. When you have this type of flow, we know it also affects HFTs, so they pull away. When they pull away, you have less market stability. Well, okay, but so I still have an issue with that kind of. So the reason that they will start to pull back is because there's enough flow going in a certain direction that it kind of changes all of their probabilities and so forth, right? Is that they can basically go in and calculate based on the volume that we're seeing, there's a high probability of informed trading out there, and I don't want to trade against that, right? So there's not some way that they go in and they say, this order is toxic and this order is not. It's like there's a certain amount after which they say it's toxic, right? But we don't have to worry about that because what we're trying to do is we're trying to predict the orders. So yeah, we can say the market makers are starting to pull back from providing liquidity in this location. But ultimately what we care about is like how many orders are going to come through. Now, something I want to point out here though, and this is what makes it so very, very interesting, is that the actual change in cumulative delta here in the treasuries is not that crazy. It's not really letting me make it big. Okay, but going back to from after the news, so from right here, we were 136 and we got to 154. So maybe 15K, 15 to 20K. So that's larger than your average move, but we just moved, holy crap, from 16 to 28. We just moved like 24 ticks, right? That's like really crazy. And this one right here, 18 ticks without even a small pullback. That's crazy. Based on that amount of flow, that's a little weak. That's a little odd and unusual. But what? So how do you explain that? Well, but look at the Japanese yen and look at the dollar here. The dollar is just cratering. So what's actually happening is the dollar is weakening and the treasuries are moving with it and the speculators are going along with it. That's what it looks like to me. Because it is actually the currencies that are driving this move. So, let me try and take a different approach to this, right? Keep in mind that a lot of this is your brain making connections and building new cells and connecting pieces here, right? And so there's a really big problem if you make a big network in your head and then that network ends up being useless to you because it's wrong or you have to go a different direction or whatever the deal is, because your brain still wants to interpret it with that model and you need to go and build another model. So it's really hard to like get rid of bad habits and bad information and so forth, right? So this idea of toxic flow, that's a very much a market maker kind of a style of doing things. And there's this kind of approach that is like, some orders I want to trade against and some orders I don't. Okay. But now just forget about that for a second and come and think about the perspective that I'm taking, which is we're trying to predict orders, right? So from my perspective, I don't really give a shit who fills me. I don't really care who it is or how it gets filled. All I care about is that there are orders behind me, that I'm getting in and that there is a lot more flow to continue pushing this thing in order to make it a profitable trade for me, right? I guess you could say what the market maker would consider toxic flow is really, really good for me, right? But ultimately, I need to make a prediction that those orders are going to be there. Today, as is a lot lately, I had a really strong flow come through that I was not anticipating. So I didn't really participate. Once it got started, I kind of did feel like, there's some opportunity in here, but where do I get in? And I'm just paralyzed and I don't take advantage of it. Do you think that it's going to keep going? Because I don't know, man. It has paused a little bit. So it kind of feels like that the move is maybe over, but like they're right there at the highs. 108 is not that far away. I think it's actually quite likely that we see 108 at some point. Well, but let's see. There could be a counterflow. We did see about 10,000 or so contracts worth of selling that created that 5-tick pullback. Wow, that's actually a lot for only a 5-tick pullback, isn't it? No, but it's not there, right? You realize that there's not like something about this order that it's a construct. The entire concept of toxicity is a construct to say this order is bad for me and my strategy. but it's not like an inherent property of that flow or that particular order, right? It's toxic to the market maker. It's a construct. There's not some way to analyze the properties of an individual order and say this order is more toxic than this order, right? It's only becomes toxic within the context of what's going on and the strategy that's being executed. The way it creates price distortions. But okay, how do you quantify that it's a price distortion? Right? Because now you're getting into something that we just know is not true objectively. Which is to say, the market, the assumption is that the market is efficient or the market should be efficient, and ergo, I have some way of calculating what the price should be based on a correlated asset and some other calculations. And then if it goes past that, then this is an aberration that I should trade against. But that's not actually the way that it works. The way that it works is orders affect price, right? And the price that we get is based off of the orders, and any kind of like fundamental price that you would be able to construct, the orders will always move price very, very far away from that. I don't understand how the paper that you were talking about the other day really has anything to do with this. They came back. Now they're below 25. So I think that the long flow is over. We are getting a really aggressive counter trade. In fact, it actually, we are right now we are at the same level in net cumulative delta that we were immediately after the jobless claims. I think that kind of lends itself to the idea that the majority of this up movement was because of movement in the dollar, and you can see that the dollar is moderating here a little bit. Jeez. Yeah, that's like this is probably too volatile to trade, possibly. Because that's like 30, that's already, oh, okay, just 2. That's already 2 basis points up, though. Well, I have read these things about toxicity, but what I'm saying doesn't contradict those ones, right? Like, you understand that their term toxic order flow, it has to do with, so it's toxic to their strategy, right? I don't feel like you understand the point that I'm trying to make. Which movie did you like more, Margin Call or The Big Short? Oh, I don't know. I think that Margin Call was more accurate to what happened, even though Margin Call was less real to life. Does that makes sense? So like Margin Call was like they took a bunch of things that were kind of happening in a bunch of different places and kind of combined them all together. But I think it was a pretty accurate portrayal of what was going on internally and how the market and the industry actually worked. Whereas The Big Short was much more ideological. It painted a picture that was not completely accurate about what actually happened and why the 2008 crisis failed. And it tries to support up this liberal narrative that, you know, greedy corporations and bad decisions by people are the cause of all of the ills in society, rather than going into how the way that the regulations were set up basically coerced everybody into doing those things. It was inevitable that people would do those things because of the rules of the game. And so I've always kind of disliked the big, even though it's like really great as a movie, I feel that The Big Short gives people some really incorrect ideas about how the market, you know, what actually happened. And I never went through an HR firing squad like that. I don't know. Like in Margin Call, wasn't like that, no. But I did eventually get laid off, and I went through multiple layoffs. I was in a different section, so it was a little bit different for us, you know. A lot of what happened with us was, you know, they're reorganizing and they're readjusting their strategy, and what I was doing at the time didn't really fit into that very well. I kind of wonder, I haven't spoken to anybody from there in a while, and I don't know where things went, because they kind of had shifted. A lot of the stuff in Salt Lake had shifted over to Marcus, and now that's kind of like not a thing. So what did they do with all those people? I wonder if a lot of my guys that were still there maybe aren't there anymore. I'm still stuck on the toxicity thing because I just don't think you understand what I'm saying. Right? Like, so let's find the one that I think you're talking about. Okay. So this one is not a study, but this is from this looks like this is a college textbook sort of a thing. Okay. And what do they say? Order flow is toxic when it adversely selects market makers who may be unaware they are providing liquidity at a loss. Right? So, what makes the order flow toxic? What makes the order flow toxic is you're a market maker, you got filled, and it goes right through you. Right? So, it's a construct. It's a construct to describe orders that the market maker doesn't want to actually fill. And so the whole game is, how do I identify when the order flow is going to be, quote, toxic to me and to not provide the liquidity? Right? Yeah, see, you're just... you're not listening to what I'm saying because you're so attached to this idea, right? All I've done so far is I've stated what is toxic order flow, right? It's toxic order flow is flow that when you get filled, you end up providing that liquidity at a loss. You end up losing money on that. You were the limit order, but you lost because it goes right through you, right? If I'm a market maker, I want to reduce the number of situations where I provide the liquidity and the flow just goes right through me, right? You get adversely selected against. So my first point is that toxic order flow is a construct, right? It's basically we're saying, okay, I don't want this to happen, so are there ways for me to identify when this is likely to happen to me so that I can avoid providing liquidity in that situation? Right? That's the whole idea. Is this is a construct that we've created, and then can we create a model that helps us accomplish that goal, right? Okay, so it's not like I can come in and I can say this order is a buy order or this order is a sell order, right? That is a property of the order that exists outside of any kind of context, right? It's like a fundamental property of the order, right? So what are the fundamental properties of the order that we got? Whether it's a buy or a sell, or whether it is a market order or a limit order, right? Now, there's also some metadata that we could potentially attach to an order, which is why it was executed, right? That's the thing we don't see on here, but we can say in, some instances, there's a reason why that was executed. It's because this guy, he's trading off of the VWAP and he thought that it was going to do a VWAP bounce. So he traded it. Yeah, I think it's more than just that the meta order was done. I think that we got a order the other direction, just not as strong of an order. Okay, so if we can come in and we can say, here are the orders that I expect to see in the future, right? I think that there's going to be a lot of market buy orders in the next 30 minutes that are going to be executing because of this reason. They think that this move is too far and they're trading against this rally because the interest rates are still going to remain high. Okay. They're trading against it, right? Is there anything about that makes it toxic? Well, it only becomes toxic if there's enough orders there that they're going to plow through the guy providing the liquidity, right? And that kind of is contextual based on what the market maker is doing and how many orders there are and all of these other things. And what the other orders that come through. Because maybe, yes, I'm executing a really big sell order, but I end up clashing directly into somebody that's buying, right? And so the net change is actually kind of neutral, right? But this implies you are somehow better able to be informed than the informed trader who is causing the toxicity. But that is kind of my point, is that if you are informed enough to know why those orders are coming in, then you can decide to not provide liquidity in that direction, right? Like, this is the thing that as a retail trader you can do that the algorithms don't really do, right? Is that I can come in and I can say, well, today is likely to be a long day, so I'll provide liquidity. I'm only going to provide liquidity on the buy side because I know that the buys are going to come through. I know that there's going to be a lot of market order buys, so I only want to catch the people that are selling, essentially, right? Why? Because I'm informed. Right? The reason, essentially, the reason why the concept of toxic order flow exists and why it's useful to market makers is because these are algorithms that don't really have the ability to be informed. That's not you, right? You can be informed. So to you, it's not toxic, right? To you, it's the expected orders. And since I'm only market making on the buy side, all of this other, quote, toxic order flow that are market buys that come through, they're really beneficial to me, right? Oh yeah, the market makers take lots of losses. On a day like on a move like we had, although we pulled back quite a bit, but market makers can lose a lot of money on trends like that. What we just had. I mean, think about it. Well, you can't see it anymore, but you'll often notice. I guess you can see it from off of these lows. So do you see how off of the lows you can see like every tick up there's like a few hundred to a few thousand contracts buying it up, but then the other side is blank. So what you'll often get is there was like no selling whatsoever. So if you had a bid out here, you don't even get filled. They just keep going up and up and up and up. Can't you predict toxic orders? Well, you kind of. So I think that you kind of can. I mean, you as a person could potentially predict that there's going to be a large meta order, right? If there's a large meta order, that large meta order is going to be toxic to the liquidity providers providing the liquidity the other direction. And so the whole thing is that they come down and they say, at which point is the imbalance between buy and sell orders enough that I'm considering this flow toxic and I don't want to market make against it, essentially, right? So what I'm saying is you could predict the future orders, but you can also come in and say, there's a certain threshold at which there's obviously something going on, right? But what I'm trying to say is it's a construct, right? The reality that we actually have is orders are orders. All orders have an impact on the market. Period. And you can construct whatever kind of this is what price they should be at sort of an idea, but the market has absolutely no obligation to honor those. It's going to move based on the orders that are submitted into the system. And so if you know what those orders are going to be, then you can predict very accurately where we're going to go and how we go about it and what prices we get. Because the stylized, if I execute a large meta order long, of course there's some randomness to it, but the estimate that you can make about how far it's going to move that instrument, you can make very accurate estimates. Okay, this I'm having a problem with my pen, so hopefully this will work, but this equation, y omega times the square root, come on, the square root of q over v. I don't know what the hell is wrong with this pen. Okay, but anyways, so y is a scalar specific to that instrument that is you can calculate and is consistent over time. Omega is the volatility. Q is the size of your order, and V is the amount of volume over there. So you can come in and you can say, if I'm going to trade 1% of the volume, expected volume for the day, how far is it going to move the market? You can calculate that very accurately. I need to just close this thing. Now it's not letting me get my pen back. But going back, the point that I'm trying to make is that this toxicity is a construct created for algorithms. You realize that, right? Like this big focus on whether orders are toxic or not is of questionable utility to a human because we cannot react that quickly. Right? The market maker, the robot, can make these calculations about the volume that's coming through and all of this stuff to cancel their order at the last second before they actually get filled. You can't. You will get filled. You'll get filled and almost immediately realize that it was toxic flow. Right? So then does it help you? Really? No, it doesn't. But what helps you? Being able to predict the orders in the first place. That's basically what we have to fall back on because we can't beat the algorithms in the queue. You can't predict this type of flow? Sure you can. You don't think that there was anybody predicting this kind of flow today? I mean, I at the very beginning was saying, I think that we'll see some big meta orders come through here. I don't know if they're going to be mostly long or mostly short. Probably I would err on the side of them continuing, but maybe the guys that think that this doesn't matter, they come back in with the vengeance and short it and bring it back down. Or the people that were shorting before all of this say that nothing has changed and they short it. Right? This is actually a situation where I think you have one of the better opportunities to potentially predict the flow. Unfortunately, I don't think that I personally am informed enough to be able to do that at the moment. But I also think that a lot of this was... for me today was I didn't really want to trade it because I knew that the Bank of England was still speaking and I was afraid that it had to do with that. So I didn't really touch it. Well, you can't consistently... Well, no, you can't predict every single time of flow. That's why you only trade when you can, right? Yes, see that fact is... a big deal, again, if you're a market maker and your algorithm is set to always be providing liquidity in the market, or you have some deal with the exchange where you always have to be providing liquidity in the market on both sides. But that's not us, right? We can pick and choose when we want to, and so we can choose to only trade when we're informed enough to have a good chance of predicting the orders. See where I'm getting at? Do you have any idea about the Robin's trading? I'm not really a huge fan of like trading competitions. I don't really feel that they are as useful or tell you as much as people think they do. The people that win the trading competitions probably just means that they're like the most degenerate of the gamblers. I was thinking of coding a market maker algo, but I feel it's too complicated. Also, commission is going to be an issue. Well, I mean, if you're a programmer, if you know how to program, okay, then this is definitely something that you can do. Is it complicated? Yes, but kind of what makes it complicated is you're going to be putting concept on concept on concept, right? So like, here's how you can kind of approach this sort of a thing is you can say, okay, I'm going to write a market making algorithm that is based on statistical arbitrage. So I'm going to look at the correlation between the 10-year treasury futures and the Japanese yen over here. And so when the Japanese yen moves down, I anticipate that the treasuries will move down as well, et cetera, et cetera. And so I'm going to adjust my best bid and offer based on what I'm seeing go on in the Japanese yen. Okay. So then you code that up and you let it run and you see how it performs. Now, maybe that's not profitable. I mean, if you're not getting a good spot in the queue, that's probably not going to be profitable, right? But then you start to add things on top of it. So for instance, you can add this thing that Lucas is talking about, where you can basically calculate at which point is there a high probability that the flow that you're trading against is informed trading, and adjust your best bid offer based on that fact that there's probably some informed trading going on there, right? So now that's another section, another layer of logic in your algorithm, right? Then you can come in and you can say, well, it's, the existing liquidity that's out there, that also kind of matters to me. And my position in the queue kind of matters to me. And maybe there are some macroeconomic factors that matter to me, right? And so it ends up becoming a really complicated thing because you can basically add like 20 tiny little edges together, essentially, right? But then even after all of that, if you're not fast, I don't know if the market making algo will actually do very well for you, unfortunately. But I mean, that's kind of the whole thing, is that the period of trading that most of our ideas and impressions about trading came from were things that happened in the early 2000s. So like from 1998 to 2008, essentially, was a time period where electronic trading became more accessible to retail traders, and some retail traders that actually had access to the book were coming in and doing the market making. And they were providing the bids and offers, and they were hitting into it with the market orders and everything, right? And this is like the period, for instance, when Anthony Crudelli had his big success where he almost pulled in $1 million in a year. Just market making S&P 500 futures on the Globex, essentially, because everybody else was in the pit, and he was like one of the first people to go into the electronic, right? Starting in about 2006 was when the banks really started to become tech companies. So before that, they had algorithms and things like that, but it was like, they had this one little unit and they were their own kind of separate. Around 2006 to 2008 is when they started to have a renaissance because of guys like Renaissance Technologies, where they basically said, we need to become like a tech company. We need to provide all of this infrastructure and all of this stuff to be able to support these algorithms and so forth, right? And that really accelerated in 2008 when the market declined. So after 2008, you came in and you had a completely different market where the market making algorithms were very dominant. So from that period, 2008 to like 2010, was when these guys that previously had a lot of success doing this kind of market making stuff, like Mr. Singh, who was the flash crash trader, right? He wasn't having success anymore. And that's why in 2010, he started doing things to screw with the algorithms, the spoofing and so forth, to mess with them. And then he got too big one time, and it apparently was, or at the wrong time. I think he was kind of a scapegoat. Like, he did do the thing, but I don't think that was the reason why the flash crash happened. But, you know, he got involved at the wrong time, and he ended up, you know, taking the fall for it, essentially. But by that point, by 2010, the algorithms were in charge, right? So then enters Seth in 2016. And what does Seth realize in 2016? Everything that he had been hearing about for the last 20 years had already happened. The edge in those things had already been taken out of the market by the robots. And so if we're going to make money, we have to take a different approach. So what was the approach that we took? What are the things that the robot can't do? The robot is not informed. The robot is not sophisticated enough to come in and say, there was a Federal Reserve meeting yesterday. The market is interpreting it as dovish. The people are buying in here. The dollar is taking a tumble because of that. These are the reasons why we had these recent moves. These are the flows that could potentially be out there. Now, that is all stuff that you can kind of that I think you can make a model, but that's not really a market making model. That's more of like the kind of model that like a hedge fund will take, right? And I actually think that if I had the data and the infrastructure, I think I could actually make a couple of innovations in that area, because I don't know. Although, you know, I don't really know what's going on in these places, but one of the things is these kind of adversarial algorithms. So one of the things that I can do is I can say, okay, here's a model of all of the different types of players that I have in the market, and then how are they going to react to this particular thing, and then I can see what the flows come out. Right? Multi-agent model to try and predict what the flows are going to be. Boom. Right. Now, I don't know if you really see it on a heat map. Just pull up a heat map and you can see the market makers in action. I don't really think that you can. Because what really matters is the latent liquidity, right? Market making algorithms kind of know that they're letting everybody see their intentions by putting the order out. So they only put the order out if they need to. So one big thing that I would note here is that, like, we had the news, which was like right here, right? And then after that, you can kind of see the liquidity starting to improve. You can see these orders up above us start to show up. And that's not, I wouldn't interpret that as one of those things like they're going to move towards the liquidity sort of a thing, but rather you can just see how there was more activity in the market. Now, the thing that's interesting about this situation is that a lot of block traders have found that their execution improves if they are also providing liquidity in the market. So, you know, if you all, you know, normally you're only seeing 2,000 contracts, and now all of a sudden you see 3,000 contracts at every price, and I mean, it's like every price, that's a really good sign in my observation that a big firm is executing something and that you're going to get a strong trend. So well, this is I'm glad that I stayed on the sidelines, because this has been quite volatile, actually. I mean, I might have taken a trade, and I don't know what I would have actually done had I gotten filled in all of these things. I suppose there might have been one scenario where I was like, oh yeah, I'll totally get filled at 467, and I got filled, and I would have taken it off probably somewhere around 462 when that first iceberg at 5K started to show up. So maybe I would have gotten a winner. But if I hadn't have gotten out, I probably would have lost all of the profits. Or I could have ended up, you know, hitting down too low down here and holding it too long and taking a loss. This is just like a little bit more range than I'm comfortable with. Why don't we create an open source hedge fund? because then everybody would be able to see our strategy and steal it and or trade against it and destroy our edge. So this is a really interesting kind of take, because one of the things that we say in open source, right, is for instance, if we're open source and we're providing security software, we're providing encryption to encrypt a connection, to ensure secure communications between two parties, right? And having it open source can be a really good thing, because then everybody can look at it and say, yep, there's no security vulnerabilities in here, or they can try and find the vulnerabilities and report them back to everybody, and you can do all of those sorts of things, right? And so typically, like, having it be open source is a big benefit, because you get all of the interaction and activity from everybody, right? But that's not what you want in the market. In the market, everybody knowing the thing, they will just do the thing and beat you to it and destroy the edge. So you don't want to do it alone. Like, that's kind of the real conundrum, is that if you're just on your own, if you're just working by yourself and you're not like collaborating and sharing information with other people like we try to do on this stream, you're very unlikely to have success all on your own too. Okay, but you don't want it to be everybody. You know, like if we were doing this, if there was like 1,000 people on this stream, that would be a problem. That would be a problem. I think that somewhere around 100 to 200 viewers, we start to get serious issues. I have to like significantly shift how I trade, or I did when we had that. That's just the thing. Is like, you'd think like 200 viewers isn't a whole lot, but like the actual amount of money that goes into the markets, it can be substantial. It can affect the market on a very short time frame, enough to screw the trade up, or enough for me to like front run you guys and just make money off of you. But I don't want to do that, right? I become more selective, essentially. I come in and I say, I'm really only going to come in and take a trade because I know that like there's just going to be monster activity, essentially. But I can't try and take this little scalp in the range sort of a thing that screws those up. So make a small group of like a dozen people and don't make it open source. That's why Markov models, well, I think that a Markov model is like a solid bit of math, and it's a little bit too sophisticated for your average retail trader. So yeah, retail traders aren't finding the things that Markov models are, or that use Markov models. So maybe there is an edge in Markov models that haven't been found by the hedge funds and already taken out of the market. Yeah, possible. I remember you doing that last summer. I don't remember my stream really taking off last summer, but yeah. The more popular I am, the more careful I try to be. Yeah, cumulative delta is now negative for the pit session. An amazing day. It is. I wonder if the well, geez, this is all really very interesting, isn't it? So if you were doing the basis trade, if you have the basis trade on, what would you have just done there? Would you have puked the trade off of it, or would you have like maybe added more? I don't know. I honestly not entirely sure. Yeah, they have an edge because of what you said about edge disappearing if many people exploit it. I suspect. So one of the things that I've always heard about Renaissance technologies is that they can basically predict everything that's going to come through. So I think that what they have is something like this. They have like a multi-agent model And they're not just modeling what the flow is going to be in the treasury. They're looking at all of these agents, and each one of these agents has a portfolio. And then these agents, X thing happens, and then they say, what do the agents do? And the agents go like, oh, okay, I'm going to take money out of this asset, out of US dollars, and sell it and take it somewhere else, or whatever the deal is, right? And then they can kind of see, here's how all of these different instruments are affected. And then they see how all of the agents respond to that. And so they have this model that can kind of predict where the money is going to go. And that allows them to position themselves like long before it happens. That's what I think is one of the things that maybe Renaissance technology does. But are we negative? Well, I think that I still want to see another 5K worth of selling to see like we get below here. But what that kind of says to me is that there's been some really strong selling into this, but that the buying didn't abate, right? Because if I get a large meta order long, and then I immediately get a large meta order short the other direction, that short meta order should go further. So if this short meta order is actually larger than the buy meta order, and it hasn't gone as far, that must mean that the buy meta order never stopped, essentially. Which means that I don't really have a very good way of predicting what the next move is going to be, because I have two flows going on here. I guess I would probably lean on the side of, the big trades have been made and there's probably less opportunity available now. Trades over 50 contracts as the end is still positive. That's actually interesting. I really wish. So there's a reason why the large institutions split all of their orders. So one of the big things that I did when I worked for the firm, the systems that we worked on, one of the biggest responsibilities of these systems was to split the orders up. So split the orders up between exchanges and ensure that they all hit the exchanges at the same time, so that you can't I'll see the orders over here and then try and front run them and get them over here. But then also, if I submit 100, submit a trade for 100 contracts, it splits it into 100 one lots for you. That was one of the things that the systems did. Why did they do that? Because otherwise, there would be a significant edge in splitting the orders out. So seeing the trades over 50 contracts is still positive. I think that does tell us something. But we can't really see what's going on with all of the ones that, that's probably only a very small contingent of the ones that are actually if we wanted to go for only big traders, right? If we look at only 50 contracts and above, I bet you that we're probably only accounting for a very small percentage of the actual large traders, because the biggest ones are splitting all of their lots into 1 and 2 lots. So then the filters actually end up telling us something kind of different, right? Which is, these are the orders that they want us to see, or the orders in which they had no choice but to trade a lot of size. Yeah, well, all of the indicators that we have, all of the order flow indicators that we have allow us to filter based on that kind of information, right? I'm merely trying to say we should be careful about what we think that information means, right? Because it could mean that they are net selling, but that they want you to think that the big orders are going long. Because they can do that, right? That's why the only filter that I have is I filter for the really, really big ones. I filter for the really, really big ones because those are either, because those tend to be magnets. Those big ones tend to have such an adverse impact on the liquidity that it kind of causes problems. So I watch for those ones. Oh, that was a pretty strong decline there from 20 to 17. So that still has me shaking in my boots about trading. Well, the buyer's side cost basis is 15. Do you think that they'll make it to 15 and bounce, or do you think that there's more selling? It looks to me like almost all of the move up in the Japanese yen has come back out. This really is a wild session. I was saying like this has me shaking in my boots about trading. Like this move is kind of dredging up some like flashbacks for me. Because I can remember times in like 2017, 2018 where I was like, this is a long, it's going to continue. And I can remember many in particular where I would like get long and we'd have a big move like that up. And I'm like, yeah, it'll pull back, but then eventually it'll bounce and it will probably tomorrow will be even higher. And then it would retrace all the way and I would scratch it. And so I'd have like a 16 tick winner or whatever and give up all of it. You remember those, Uzi? Like, this is so much like that, where it's like the strength of the flow and everything else tells you that this could very, very likely be a trend day. And it completely reverses. And it's just like so wild to see a flow that big and that strong completely reverse. But I've seen it so many times now. I almost kind of start to wonder if it's like if it becomes over a certain size, it's actually more likely to reverse or something. I don't know. It's just crazy. It's just crazy. And I honestly am not sure I can completely explain it all either. I mean, I do think that a lot of it was currencies, but from where we're at right now, it was a net 30K change. So that was 30K buy, 30K sell. And usually if you have a day and it's 30 to 40K buy, like if it's a double distribution day sort of a thing and it's 30K change, like that's a big move. That's a big move. So to have a big move up and a big move down is wild. And I'm not sure I can 100% explain what kind of flows would be driving that. I mean, I think a lot of it probably is speculation. I think that we would see more speculation and like, risk-taking hedge funds, that sort of a thing, getting involved here today than usual. But my single order that started the sell was 1307. Oh, you say that there was a big order at 27? You say started this swing? Yeah, well, that's interesting. I think I can see what you're talking about too, because like if I come in here and really make things big now, you can see right here in this bar, there's like a big decline there. It was like there was probably multiple orders that sold in there, but that does seem like that's where it started. And then ever after that, it was like they struggled to hold it. Will these flatteners ever stop? Well, there's the other interesting side of it is that it did flatten, didn't it? Which is not, you see, yesterday we steepened, and then they gave it all up and they started flattening, which is, I'm not sure I understand why that happened, but. But I would argue, by the way, so here's the way that I see it, is there was a large order at 25. Do you see it right here? Let me pull out the other pen. G-Ink. G-Ink doesn't seem to have the same problem that Epic Pen does. I don't know what the Epic Pen's problem is, but like it just like goes unresponsive sometimes. Okay, so right here, you can kind of see this little cluster. That's where a 5K iceberg originated. And remember that the quote-unquote pattern, one of the patterns that I look for, that's just a me thing, I can't prove it, okay, but it's just a thing that I find tends to happen on really big orders. It's like the people that execute this like to do this for some reason, is you'll get the big liquidity hole start to form, and then they'll shove it just like one more time. It's like they shove it one more time, then you get the actual pullback, right? It pulls back to 25, bounces, comes, and then you really start to see the selling. Okay, so what I think happened was this. Large meta order, okay? Liquidity, well, actually, it would be like large meta order, liquidity hole, and then the shove, and then opposing meta order. Yep, so let's redraw that. Opposing meta order. Right. But the buyer didn't stop, apparently. There's still some buying, and that's why this move didn't get as far. In fact, they're not even back to the buyer's cost basis. So there was a lot of buying. But does that make sense? Like, the reason I'm pointing that out is because you're saying like that big order started at 20, it started at 27. But pay attention to this thing first. Liquidity hole formed, shove higher. Okay. That's probably the end of it. And I remember saying at the time, this is that, that leg of the, might be done, right? Then that big order selling was a sign that, oh, there is an opposing meta order, right? So when we see an opposing meta order like that, those are some of the best trades. We want to go with those ones. I didn't really catch that. I was still too terrified to trade. Well, didn't I say, like, oh, I don't think that you sell it here, but maybe you take profits? Yeah. So, like, I just find it so interesting that when we analyze the market, the volume after the fact, that we can see these stylized behaviors in it every time. Like, they really are consistent behaviors in the market that can kind of help you read what's going on a little bit better. So you can kind of see that, okay, we had this move here. It moved up. Now I'm starting to get this stuff at 20. Okay, well, that's the liquidity hole. You'll see that every time. That doesn't mean that it's over, because I think a lot of people, they see the absorption, they see the big iceberg orders and things like that, and they say, oh, let's go short now. Well, no, because what are the future orders going to be? That's all that matters. Because the big orders just kind of means that it might not go anywhere for a while. But if we still got to buy meta orders, it's just going to do this. Right? That allows us to kind of get in the flow and understand what might possibly happen here a little bit better. Especially if we really have good information to predict the flows. Although I'd have to say, even at the time, if I had caught that 1,000 lot meta order, yeah, this right here, that's totally, I think, reasonable. But this amount of delta change, it was like, whoa, what? That's crazy. These stylized behaviors come from multiple papers, right? But if you go and read Trade Quotes and Prices, that's basically what that book is all about. Or you can watch my video on it. But the most important one, like in all seriousness, the most important one is the square root law of meta order impact. That in my opinion is the most significant. Once you start to look at the market, instead of it like this, you start to see it as like this. Right? Really, I think it really improves your insight into what's going on. Consent to make the cost basis for Sierra for Christmas. I mean, maybe. I find it interesting that you guys are still that interested in it. Because, like, I don't know. I mean, just for the fact that you want it, it probably should be a good enough reason for me to do it. Because the issue that I've had with the cost basis is I see a lot of things with it that really so strongly suggest that something is there, but I seem to be unable to be able to squeeze an actual edge out of it. Right? Like it's doing something, but I've been unable to figure out how to use it to make some sort of a prediction or to help the trade, you know? I just know that this is this level they tend to react to. Are they going to bounce out over it or go right through it? I don't really know. But, you know, I put those things out there so that more people could, use them. And I have had them, but, you know, it's a pretty sophisticated thing. Only a handful of people have actually been sophisticated enough to do anything with it. And Octavius is one of the people that I think is sophisticated enough. And he's been around for a really, really long time. But he's on Sierra charts. So, but I probably could, although I do have to say, the data structures and stuff that were necessary for me to make the cost basis is going to make doing it in C++ really complicated, but I think I'm up to the task. It would have to be not for Christmas, though. It would have to be like after Christmas, because that would be with the time that I would have the ability to do that sort of a thing. I don't know, though. We got like other stuff to do. Like, hopefully, if everything goes according to plan, I will spend some of the Christmas break. Although I don't think I'll have as big of a Christmas break as I usually do, because the new job and everything. But hopefully that would be when I can start building my own Chat GPT thing. I should maybe think about getting the other case. Well, at 20, they're building another hole. So that may become a reference price or like point of control for the session sort of a thing, except for that the 30-year is spiking back up here again, and we're getting some flattening behavior now. Some pretty aggressive flattening behavior. Oh, wow, actually. That was weird. I need to recenter things. That's what I need to do. Well, so let's come over to Zero Hedge and see. We've probably got some stories here now to read that might help us. Oh yeah, we had the top of the hour, didn't we? So that drop there was that news. How come I didn't hear? Well, okay. I'll just come over here. The U.S. factory orders month over month 2.8 versus 2.3. Core durable goods revised 0.4 versus 0.5, and U.S. durable goods revised 4.6 versus 4.7. Seems like that the factory orders kind of caused a little bit of selling in the treasuries, but they've like recovered that since. What's with the NinjaTrader 8 data? I downloaded 1 year of VS in Excel. So probably the reason for that is because you are using continuous contract back adjusted, right? So what I would do is come over here, tools, options, and then market data, global merge policy, merge non-back adjusted, or just do not merge. Because if you're using merge back adjusted, then what it does is it's adjusting all of the prices to try and make it seem like it was one continuous contract. And so those weren't actually the prices that it was actually at. You really are the chosen one. Thanks. In some respects, I think that I am special, but I'm not special per se. Like, I think that when I say I'm special, that people say like, oh, Seth thinks that he's some sort of savant genius market person or something like that. No, I don't think that that's what it is. I think it's just that I've been around doing this for so long now, and I've run into all of those problems, you know? That's really all it is. This is the same reason why, like, you usually when somebody says something and I kind of get, really like, I'd be really careful about that sort of, like when Uzi was talking about filtering the orders out, or when Lucas was talking about the concept of toxic order flow. It's because I gave huge precedence to those things at one point or another, and then discovered information or had experiences that kind of suggested to me that the way that I was using it was wrong, right? So I used to really care about filtering things out, and I kind of discovered that it didn't really, the amount of actual informational content that it gave me was very, very, very small. So that doesn't mean that it's like bad to put it up there, but, gosh, if I like filtered everything, I could probably have like 6 more strains, right? And it's the same thing with the toxic order flow. Like, I spent a lot of time trying to figure out and quantify what flow was toxic and so forth. And I realized that, really, if I have something that's predictive of the flow that's going to come in, I don't really have to play that game. So, it was a better model that was better suited to what kind of edges are available to us as retail traders. And it's the same with all of the back tests, because I've back tested a trillion things, and there was a bunch of times where I thought that I had found something, and then I realized that it was just because I wasn't being picky enough with how I what is the word? Not picky, but like being hard on it. Like I wasn't giving it a difficult enough back test, essentially. And so I was falling into data snooping and curve fitting. What's this? Oops, that's not even what I wanted to look at. Oh, what's this? CME Group invites you to share your simulator feedback. There's something going on at work I want to read here real quick. Where is that? Oh, okay, they're doing a pull request. A decent amount of call buying in TLT at 88? Jeez. Well, so, you know, we checked that earlier. Let's check it again, shall we? Because, you know, the first set of big calls that we had seen in TLT was at 85, and they had kind of touched it, but not really become enough to pay for the premium. But I think that was before we had that insane uptrend. So where are they at now? Now they're at 86.83. I see. So the 85 calls are in the money, because those ones were in the money at 85.45. So they've actually made, let's say 55 plus 83, so 135, $1.35. So they've made $135 essentially per contract, which isn't that much, but then there was some at 87, and those were only like 10 cents. So those ones just barely got to break even, and that's where we stopped. Maybe the price that we stopped at is related to the TLT options. Because that is almost to the tick. That is to the tick. They got right to break even and they turned. Wow, that is wild. But you're saying that now they're buying them at 88, but what are they costing them? Okay, fine. Let's come in here. Hold on a second. Gary publishes new videos all the time. Last time I saw, he was talking about terminology and things that can kind of tell you whether somebody is a professional or not. Which I thought was going to be interesting because I've definitely seen a lot of gurus and stuff out there kind of doing that sort of crap. Misusing terms to trick retail traders, essentially. Okay. So, question, Octavius. Which expiration? I'm going to assume that we're talking about yeah, I'm going to assume that we're talking about November 10th. 20 strike supply. And 88 calls at 88 are now 64 cents. And what are 85s at? 237? 15 days? Isn't that? Yeah, that is 15 days away. No, that's not. That's only... So you must be talking about the 17th then. $1. So in order for them to make money on that, we'd have to get above 89. What do you think the chances are of that? 89. I'm not sure they'll make it, dude. I mean, again, I find it incredibly curious that they went literally right to where... So we looked at... When was this? Like 3 days ago? Let me come back here. I think I've gone too far. Oh, we're gonna get the oil numbers here or whatever. Or gas. Oh, come on, where is it? $85. Okay, so this was the 30th. So this was last Friday? No, it was Monday. Okay, so on Monday. I came in here and I looked at what the options were. And the two strikes that were the most popular. And the two strikes that were the most popular were 85 and 87. And at 87, they were asking 10 cents for calls for the ones that expire next week. So 10 cents for calls would put your break even at 87.10. And I find it odd that they literally went right to where all of those options would become profitable and turned around. But now the calls are coming in at 88. I mean, look, they made some money. It looks like they made 3-to-1 money. Right? Could have bought 50 of those and made... not 50 of those. 10 of those. Could have bought 10 of those and made a couple $1,000, I guess. You could have bought 10 of those and made $1,500. Yeah, it's not bad defined risk. It's not like an insane trade, but it was a good trade overall. It was a mild, you know, I still kind of feel like that some of the people were like buying lotto tickets, but that I guess the way that it kind of played out does kind of verify some of my concern, which is like you're buying a lotto ticket, like the good thing happened, you made a decent profit. It wasn't an insane winner. But maybe I look for the shooting for the moon ones a bit too much. Seem to have fallen down from that 20 area now. Even though I'm still seeing the 30-year pushing, so I'm seeing a lot of flattening come through. A lot of flattening come through. How should we describe what happened today? The whole trade that we got here today, the whole thing is just nutty, right? What do you mean the crowd finally realizes they have found the chosen one? The number of viewers today is going down. We're at 17 right now. You guys must not be clicking the like button. That's what the Not today. That's a good one. We'll save we'll put that one on the back burner for another day. It's a Karen day. Dude, I'm well, okay. I guess I sometimes I'll come in and I'll be like, okay, we just saw the move, and I'll be like, what does that mean? But then almost immediately the next thought that I have in my mind, and this is a mistake that I made so often, was that I didn't consider, okay, what are the next pieces of news, right? Because I think the reason that I have that kind of like tendency to start thinking like that is because I want to turn these into swing trades at some point. So I'm sitting here like, okay, so like what's the next stop? What's the next stop on this as a swing trade? Like if you were long with this on a swing trade, do you stay long, or did you take profits on that insane move up? And I'm kind of leaning towards that you took profits on that one up, but who knows, there could be another leg of this. But then I go back and I say, oh yeah, except for that there's a non-farm jobs report tomorrow. So what are we waiting for on the, what are the estimates for non-farms tomorrow, huh? Okay, so we're looking for a non-farm employment change of 178K versus a previous reading of 336. So they're anticipating that this huge outlier that we had last month is going to come back. Now, what was the estimate for last month, though? Okay, so they were expecting around... Oh, they were expecting 171. So their expectation was 171, and this time the expectation is 178. So the estimates are all kind of just reading that last one as an aberration. So I think that there is a risk that that number comes in higher than anticipated again. I would want to read, and I usually get this stuff from Zero Hedge later in the day, in the evening, but I would want to see like the ones that are kind of more important on this. So like Goldman Sachs, JP Morgan, and Bank of America, what they think it's going to be. Do one of those as an outlier, think that that's going to be more like 250 or something like that. But so I can see a possibility just right in there that this number is higher than anticipated again, and the market throws a fit, right? Wouldn't that just be like, and that just seems like the most ironic thing that could happen is we get this huge trend after the FOMC, and then non-farm comes and just destroys all of those gains because the market is still too strong. But then after that, what do we get next week? That's where I think it starts to get really interesting, because in the equities, most of the flow analysts that I'm seeing are all seem to be suggesting that the flows are very much long going into the rest of the year. Okay, so next week we've got bond auctions. So we don't get the CPI. CPI is on a Tuesday. What's with that? Okay, so we don't get CPI until the 14th. That's interesting. And it's also interesting that all of those TLT options expire before the 14th. But that gives a lot of space for the treasuries to be making speculative moves, right? So that's going to be a pretty difficult trail to maneuver through. I always feel like that's the case, but it feels like it's getting harder and harder and harder all the time. All the time. Auctions next week. Because the issue with auctions next week, right, is that supply coming in has been hurting the treasuries every time. Or at least a lot. But we did have the refunding announcement was less than expected. Maybe it's not as much of a problem this quarter. I guess we'll find out next Wednesday. Sorry, which one is the 10-year? The 10-year is the one that I think was the worst this time. Yeah, next Wednesday. So I guess we'll find out next Wednesday. But should be careful about it. We still got 20 minutes, by the way. We're just talking about the title. I put a title in Insane Post FOMC Trend and Reversal, because I want to note, like, if you really want to look for a really big trend and a reversal, I think today is one of the best days to look. We can use those other titles we came up with that are kind of funny on another day when we don't know what to use. Also, I want to come back in here in show chat on Discord. Oh, this one was the wrong one. Oh, right back to 22, huh? Man, you just Well, you know what? I'm not paying it very well attention, but this thing moves, man. I mean, that's like that's 20 ticks. This is probably too volatile for me to trade. I mean, I can trade it, but every time that I start trading in this amount of volatility, I make big mistakes, right? Question is, will we continue to get this amount of volatility next week? I guess it depends on what the non-farms is, huh? Can I put a price level on this chart? So this is curious. The 30-year is pushing up here, and that's leading TLT back up to the highs. There we go. I tweeted something. We'll see if anybody likes it. You have a good one. You too, Dewey. This latest little move here is a pretty decent trend. That one is not to be trifled with. Though I do think like the ZB is definitely leading that charge. Well, we did see some buying in the 5-year with it too, but not in the 10. I'd still say flattening involved. Jordan intercepts drone coming from Syrian territories, says Jordan Army. Well, S&P 500 is not backing off, is it? I mean, that's really what it should be, because what I've got right now says go long into year end, you know, and you could have picked up 28. I mean, that's a freaking 40 point move. That's like what on micros? Even on micros, that's like $200, right? No, point is 50. Point is 500, but that would be 50. It's 10 points. So it'd be $100 move. Or no, a $200 move. $23 has had a lot of volume here now. Well, it kind of seems like I'm going to have to go, like, just as it gets interesting again. I'm a little bit skeptical about that the 10-year will bust the highs again, though. I think that probably this flattening flow that we're getting will it subside, and then the 30-year will back off again. And if it doesn't, you could have another really strong trend up. Does seem like that we've gotten like the liquidity hole and those volumes have like backed off, but the 10-year, or sorry, the S&P 500 is going for another leg still. So also really curious that gold took a bit of a tumble today. Bitcoin, they were up overnight and everything, but they've been falling all day too. Which I would have expected Bitcoin to hold its gains if it's risk on. But there might be a bad headline coming in on that one. So we'd be careful on the cryptocurrencies. Why can't you get market? You do. So what do you think is at the bottom of the screen here? The last little jump from 16 to 24 in ZN is all on negative delta. Oh, you're right. Which says we probably shouldn't trade it. Probably. I mean, it's been a really long time since we've had a move like that in the treasuries, isn't it? What is it with you guys in chat that y'all perk up right when it's about time for us to get going, so that you can get me on another rant and keep me going past when I'm supposed to be streaming? What's with that? Oh, you were trading again? Really? Okay. The 30-year looks like it wants to keep going. It really looks to me like the 30-year is driving this. It's just that most recent push up, there wasn't really cumulative delta change in the 30 either, nor is there correlation with the 6J or the dollar. So I'm not entirely sure what to make of that. There could be some moves going on in the cash market that are being hedged against in the treasury in the futures market or something like that. I don't have enough data to explain that one. But it suggests to me, just as Uzi said, that means that the market has shifted into a market that is not very much not favorable to us. Bouncing back and forth between platforms. I took a short at 25.5 and at the big 27 right at 20. Oh, you bought some Dominion. Oh, okay. Wait, why Dominion Energy? Man, UB is up 2.33%. That's a monster move, man. Actually, if I come in here on to what is today? It's an up day, but it's actually not that big of an outlier in terms of range for the 10-year. Your long-term strategy. Are you still in on that AT&T, by the way? Because our last time we was doing research about that one, it really soured me on telecoms. Oh man. So like apparently what's going on is the telecoms now have to put a ton of money into like building up and updating their networks. So you get this period where they have to do insane amounts of investment and they don't really get anything for it. It just keeps them in business. It doesn't like really increase their profits or do anything crazy for them. And apparently that is why stocks like AT&T have just been languished so much. So if you're going to be in AT&T, apparently you only do it for the dividend. Like, it's only if that dividend makes sense for you. Otherwise, it doesn't really make sense. Because what is the dividend yield on AT&T? I'd hope it's more than 5%, right? $7.06% or $7 per share? Oh, what is the symbol for AT&T? It's T. There, yeah. I knew it was something really stupid and simple. It is 7.06%. Okay, let's verify that. I think it's under statistics, right? Forward annual dividend yield 7.12. I guess it makes sense. Like a 7%. I'm not going to say it's a guaranteed yield, but 7% is a decent one. Obviously, if you get into something, you know, that goes up, you're going to make a lot more, but I hope Verizon do. But don't you feel like you're a little dividend heavy now, though? No? Because you got that, you got TLT, and I haven't checked Zillow in a long time. How are they doing? I've heard they got hammered by that losing that court case. Ooh, yeah, it's pretty ugly over the past 6 months. Since August, it's been really ugly over there. How about, I think we need to go to like 5 years to see it. I had it. So I bought it like here at like 60. And then I think I took it off at like 45. So I actually was able to claw back a good portion of my gains and get out before this latest decline came in. So that is not very... That's very, very energy heavy. Altria, I'm not sure what they're about. They like a medical company? It sounds like a medical company. No, they're another dividend, large dividend, huh? I think, I'm not exactly sure which parts we want to be in, but I think that I want to be in small, like I want to find small caps that are okay with high yields. Essentially. Small caps that are okay with high yields. Let's see here. Small cap stocks with low duration. There you go. The 7 best performing small cap stocks. No, Costco. There you go. Costco would be a good one. Bunch of therapeutics. Okay, well these are all the names that are moving up because of the weight loss drug, huh? So that doesn't really help us. No Costco, says Octavius. Should we add Costco to our list? And where is it? Oh man, where is it? Is it this untitled one? Nope. That's a budget. Oh, it's time for me to get going, actually. Oh, you know why? Because I think I put it in an Excel spreadsheet. Excel. There it is right there. So I'm gonna take a wild shot in the dark because you've got like Sunoco, Chevron, ConocoPhillips, Kinder Morgan. It seems to me like probably the best of those would be ConocoPhillips, but that I would be interested in, but I'm not exactly 100% sure. Okay, so here I'm gonna add one here for. We'll add a couple of them. Actually, let's just add all of the ones that Uzi has in there, because this spreadsheet should help us do like some analysis, right? So, this one will be, well, I just put the names in here because I don't know the symbols of them all. Dominion, Sunoco, Chevron. Come on. Insert Chevron, Conoco, Phillips, Kinder Morgan. Kinder Morgan is like infrastructure, right? Yeah, they're energy infrastructure. And then let's see here under, I think Costco is considered consumer discretionary, right? I'm not actually 100% sure. Maybe it's Staples, but we'll put it over here. Costco. XOM2. Oh, ExxonMobil. I need to do some things here like yeah, this should be bold. Financials. Probably I'll need to like split them out. Make this like its own, right? Like insert here. Make this Goldman Sachs. GS. Like that. I don't remember what was the stuff that I wanted to look at that, you know, I was going to start making my decisions based off of. I think one of them needs to be duration is what I'm going to call it. It's just what is their sensitivity to interest rates. But anyways, because I like to do kind of a top-down, bottom-up approach. So I go top-down, deciding which sectors I want to be invested in the most based on the anticipated interest rate environment, which is interest rates being between 5 and 2.5%. And then from there, I go down into which company is the best in that segment or whatever the deal is, right? So duration is going to be important for me to decide which sectors I want to be in, essentially. Oh, that's actually what wish is. Can you quantify the duration of an industry, and is there information like that out there? I bet there probably is. That would be way better than like these ones that are like, okay, what does, well, you know, there's always this one that's like, here's the sectors that you buy when interest rates are high and when they're low, and there's like a chart and stuff. Or really what I should do is just like, what is the duration of that industry to interest rates, positive or negative? Okay, we can continue that on Monday. You bring all your stocks. We can continue that on Monday. But it's time for me to get going. So I'm a little disappointed that I didn't take any trades, but you know, after having seen the way that it went, and I felt like I'd missed it, and then it was like super volatile on the pullbacks. I'm actually really happy that I didn't end up taking a trade, because that could have ended up bad. I don't really know what I would have done, but that's volatility makes me a little nervous, and I've had struggles with it in the past. So I'd rather just skip that, especially since I didn't have a super strong reason to believe that flows like that were going to come through. Like, I don't know. I kind of feel like that a lot of this action is just kind of like craziness and not really justified by the fundamentals, of course, but of course nothing is, right? So tomorrow, non-farms, that's the big one. And then after non-farms, then we can kind of take a look at where things are going and decide what we're going to do. So until then, I will see you guys tomorrow. Stay excellent.